If you're building a life here in Dubai, I guarantee you've asked yourself this question. Does it make more sense to keep paying rent, or is it finally time to buy a place of my own? It's a massive decision, right? It's not just about money, it's about your life. So today, we're gonna break it all down.
Okay, so let's just dive right in. We're not going to start with some abstract theory. No, we're going to use a real-world case study from a Dubai resident who actually posted this online, laying out all their numbers to try and solve this exact problem. They've basically done a ton of the homework for us, and now we get to dig into the results.
Here's how we're going to tackle this. First, we'll look at the dilemma itself. Then, we'll run a 15-year financial showdown, the hard numbers. After that, we'll explore two different strategies for buyers and the alternative path for renters. We'll wrap up with a framework to help you decide and a look at the 2026 market outlook.
All right, part one, the Dubai dilemma. So here's the scenario. It's a classic situation. Someone is thinking about buying a two-bedroom apartment for 1.65 million dirhams, or just keep renting a similar place. This is that exact fork in the road that so many of us face here.
Now for Section 2. The 15-year showdown. This is where it gets really interesting. We're going to project both of these choices, renting and buying, out over a decade and a half to see which one really comes out on top. No guesswork, just the numbers based on a clear set of assumptions.
So let's lay out the ground rules here. In the buying scenario, you've got that 1.65 million dirham property. This needs an upfront cost, a down payment, of 427,000 dirhams. Now, in the renting scenario, that same 427K isn't used for a down payment, it's invested. We're assuming the property value goes up 3% a year, rent goes up 4% a year, and that investment makes a 10% annual return. These assumptions are basically the engine for our whole calculation.
So, after 15 years, what's the total cash that's gone out of your pocket? Well, owning the property costs about 2.23 million dirhams in total. Renting, on the other hand, comes in at about 1.6 million. So you might look at that and think, well, renting is cheaper, case closed, but not so fast. That's only looking at the money going out.
Because at the end of those 15 years, the buyer has something the renter doesn't, an asset. So after they sell the property, which has gone up in value, and pay off the rest of the mortgage and all the costs, their net financial gain comes out to a very nice 336,000 dirhams.
And what about the renter? Well, their initial investment, 427,000, has grown quite a bit, but when you subtract the 1.6 million they paid in rent over the years, their net financial gain is 181,000 dirhams. So based purely on these numbers, buying comes out ahead. But, and this is a really big but, you have to remember how sensitive this is. If the property grows a little slower or the stock market does a little better, this result could easily flip.
Okay, on to part three, the buyer's strategies. See, deciding to buy isn't the end of the decision-making. In a way, it's just the beginning. The biggest question you have to ask next is, what kind of investment are you trying to make? There are really two main ways to think about this.
First up is what we call a cash flow strategy. This is all about one thing: generating a steady, reliable income stream, month after month. The goal is for the rent you collect to be more than your mortgage, your service charges, and all your other costs. It's about putting money in your pocket today.
The second strategy is all about capital growth. With this approach, you're not so worried about the monthly income. Instead, you're making a bet that the property's value is going to go up a lot over the long term. The big payday comes when you eventually sell. This is about building wealth for tomorrow.
This table really lays it out perfectly. A cash flow focus? You're all about that rental income. It's generally lower risk and doesn't get tossed around as much by market swings. A capital growth focus? That's a bet on appreciation. It's a longer game, with potentially higher rewards, but yeah, definitely higher risk.
All right, part four. Let's talk about renting again. It's so easy to fall into the trap of thinking it's just throwing money away. But we really need to stop looking at it like that. It can actually be a very smart financial strategy, one that values flexibility and freedom over owning a physical asset.
I mean, the case for being a renter investor is pretty strong. For one, your capital isn't tied up in a building. It's liquid. You can move it around. 2, no surprise calls about a broken AC or a leak. 3, you have complete flexibility to move if you want to. And 4, your entire net worth isn't tied to the fate of one single property in one single market.
So that brings us to Section 5, your decision framework. We've crunched the numbers, we've looked at the strategies, but how do you apply this to your own life? It really all comes down to answering 3 key questions honestly.
First question, do you need some extra income coming in right now?
If the answer is yes, then finding a property that has a positive cash flow could be a perfect fit for your goals.
Question 2. How much risk can you stomach? How comfortable are you with the market going up and down? If you're okay riding out those waves for a potentially bigger payoff down the line, then a capital growth strategy might be for you. If you prefer stability and predictability, then cash flow is probably the safer way to go.
And finally, what's your time horizon? A capital growth strategy demands patience. It's not a get-rich-quick scheme. You have to be prepared to let that investment sit and mature for years, maybe even a decade or more, to really see the kind of appreciation you're banking on.
Okay, last section, and this one's a biggie, the 2026 market outlook. Look, no decision like this is made in a vacuum. To make the right call, you have to understand the bigger picture, what the experts are seeing for Dubai's property market in the near future.
So, the headline number is this. Experts are generally forecasting a return on investment for Dubai real estate somewhere between 6 and 9% for 2026. Now, that's a really healthy return, competitive with a lot of other big global cities, and it gives us a realistic baseline to work with.
But an overall average doesn't tell the whole story, does it? The picture is very different depending on which part of the market you're looking at. The luxury villa market, it's outperforming, thanks to high demand from wealthy individuals and not a lot of new supply. Office space is a huge standout, mostly because there's a shortage of top-quality Grade A space. But, and this is crucial for our case study, the mid-market apartment sector is looking like it will stabilize or be a mixed bag. Why? Because there's a lot of new supply coming onto the market, which could actually lead to price corrections of 10 to 15% in some areas. That's a key risk you have to consider.
And of course, on top of all this market data, you have the things that make Dubai, well, Dubai. We're talking a tax-free environment on rental income and capital gains, a super stable currency that's pegged to the US dollar, and powerful incentives like the Golden Visa for property investors. These are the big reasons that continue to pull investors in from all over the world.
Which brings us right back to the beginning, with one final question. After all the numbers are run, after all the strategies are weighed, what does owning a home in a city like Dubai really mean to you? Is it just an asset on a spreadsheet? Is it a place to put down roots and build a life? Or is it something else entirely? Ultimately, that's the one answer only you can decide.